Alright, good morning then everyone as we head into European trade on Thursday the 5th of October. We'll flick across the headlines, see what's going on, we'll jump across to the calendar and some charts now in a minute. But again, some kind of opinionated pieces. Bond vigilante circle battered US Treasury market. You know, bonds continue to bonds continue to move lower. They do in today's session. They have had a bit of a pullback, pretty strong pullback. A bit of a rally in bonds, move lower in yields over the last couple of days. But I think the interesting thing to look at is the Japanese yen. I mean, we were speaking yesterday, on yesterday's video that, you know, there was a Reuters article that suggested that there was no intervention from the Bank of Japan. Now you can see it's unclear if officials just intervened to stem currency losses, but the debate ignores the bigger issue. I mean, there's a debate between have they intervened, have they not. There was a Reuters report that suggested that their current account does not state that there was any intervention. There wasn't any, you know, increase or decrease of their current account, which suggests they have not jumped in and bought a load of Japanese yen. So I think that's an interesting thing. Then what that move was the other day becomes even more of a question. But that is one question. On the other hand, intervention or no intervention, you know, ultimately with yields where they are at globally across every other nation, and then where they are at in Japan, and with them continuing to buy bonds to keep yields suppressed, that doesn't really change any of the picture. The whole thing about Japanese yen weakness over the course of this year so far is due to the fact that yields in Japan remain subdued while yields rise globally. It makes other currencies more attractive for investors over the Japanese yen. Therefore, other currencies appreciate over the Japanese yen, and that is not something that has changed just yet. In order for them to really get the market to turn around and get the Japanese yen to start rallying again, they will need to adjust monetary policy. But you know, if they do adjust monetary policy, they, you know, their debt to GDP ratio is the highest in the world. So it's not really a situation that they want to put themselves in with raising interest rates. Obviously, it raises interest on all of that debt. So yeah, in a bit of a kind of catch-22 scenario. Ultimately, to truly stop that trend, to really get the yen rallying, they will need either, you know, global yields to fall drastically, or just monetary policy, which are either of them going to happen anytime soon? I'm not so sure. So, you know, we're talking about certainly looking at these charts. I'm going to flick through. You know, that's kind of the thing about these videos. You do these videos twice a day and kind of say things before taking everything into full consideration. We were looking at this kind of little descending triangle kind of after or post intervention, but whether it was or wasn't, I'm not so sure anymore. But a little bit of a descending triangle here that has popped to the downside. But ultimately, once you kind of take a step back a bit and forget about intervention and no intervention, obviously, you know, made those comments when we thought it was intervention. If it's not, regardless now whether it is or isn't, once you take a step back and you actually think to yourself, nothing's really changed, the picture is still the same. You know, you might get a bit of a rally in the yen off the back of it, fair enough, but ultimately, you know, markets will be awake to the fact that, and the picture is still the same. And if you look at bond yields, you can see the 10-year and the 2-year after their pull off, they are now rallying in today's session, albeit that's a pullback against this move over the last couple of days, or it was really all day yesterday, just yields getting hammered. But bonds rallying, yields getting hammered all day yesterday, and then into today, a bit of a bounce back, which has sparked a bit of a bounce back in the US dollar. You can see across the board, your Aussie, Kiwi, Euro, Sterling, all kind of moving lower to begin the session today. You see dollar Swiss, dollar CAD, dollar yen, all grinding higher. Dollar CAD a little bit higher in today's session. Oil has just continued to the downside. There's been a little bear flag in the price of oil. That's continued to the downside. Gold, choppy as anything. Probably want to stay away from that just as of now. In terms of stocks across the board, the S&P, the Dow Jones, the Nasdaq, the Russell, all taking a turn lower in this morning's Asian session. The DAX, the Euro stocks, the FTSE, all taking a turn lower as well. So a bit of negativity in stocks this morning. Yields pushing higher again, potentially helping to drive a bit of negativity in stocks. Look at the US dollar, bit of US dollar strength. So this is the trend that you've seen over the last number of months, kind of against the last couple of days. But if yields continue to push higher, dollar higher, stocks lower, means this economic data is kind of rendered a bit obsolete. It certainly as of now, but I wouldn't completely disregard ADP employment change. That is an extremely negative number out yesterday. Job openings on Tuesday, extremely negative number. Does that again? We're saying, does it change the picture? Does it completely change the trend? No, not yet. But we do have non-farm payrolls and the unemployment rate tomorrow. That then right there is going to be it's going to be a little bit of a tricky release. Maybe you've got on one hand, you've got markets wanting to push dollars higher, wanting to continue to push dollars higher. On the other hand, weak economic data, weak labour market figures does not really make a situation in which the Fed will want to continue hiking interest rates. That is not likely to put upwards pressure on inflation. Oil is what's likely to put upwards pressure on inflation, and even that's had a bit of a pullback as well. So, does it reduce the need? Some weak economic data tomorrow reduces the need for another interest rate hike. Potentially causes a bit more of a pullback in the US dollar. But we got to wait for tomorrow to see. In terms of today, it looks like the US dollar wants to push higher. Markets will do what the markets want to do, but if yields push higher, equities lower, dollars higher. As I said before many times, the trend is your friend. Does that play out? Is another question, but there's a bit of a dip to buy back into in the US dollar. Once it stays below this level at 106.50, as you can see down here, I think it maybe look for further upside, but it is a little bit of a choppy one. We were looking yesterday morning for a bit of a bounce back in the dollar. We have got that so far. Does that continue for the rest of the week? Obviously, it remains to be seen. But the trend is your friend. I'm a firm believer in the trend continuing for the rest of the week. Not really. I'm a bit unsure as to what to do in this morning's session. US dollars, expected a bit of a bounce back. What we have got is a bounce back. They look like they sort of want to roll over again in this morning's session. So I don't know if I'll buy it just yet. I'd probably approach today with a bit of caution. Jobless claims at 130. Keep an eye on it. Anything above consensus at 210 again further reaffirms the stance of potentially a weak NFP print tomorrow. Anything below consensus in the jobless claims makes things a little bit more tricky over the course of this week. But yeah, one hand, we've been looking for a pullback in the dollar earlier on in the week. We seemingly have got that. Trends kind of look like they want to kick back in again. So I'm a little bit undecided as to what to do. Maybe a day, keep your money in your pocket. Don't trade unless anything major happens. But jobless claims, as I said, 130, main focus of attention today. Keep an eye on that for some fresh clues as to what to look out for heading into tomorrow.